In the grand chronicle of human ambition, there is a universal truth. The first step is the hardest. The first dollar earned, the first acre cleared, the first victory secured. These are the moments forged in the crucible of uncertainty and struggle. In the world of speculation, this truth is magnified 1,000 times. Here, the first significant stake, that initial $10,000, is not merely a sum of money. It is a barrier, a trial by fire, a tuition fee for an education that no university can offer. It is the price of admission to the greatest game in the world. The story of Jesse Livermore is the ultimate testament to this principle. It is not a simple tale of rags to riches, but a profound narrative of transformation. It is the story of why earning his first $10,000 was a relentless, soul-crushing battle for survival and knowledge, and why, once that battle was won, the next million became not just possible, but in a strange and logical way, easier. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The genesis of a master speculator is rarely found in the halls of finance or the classrooms of economics. For Jesse Livermore, it began in the chalk-dusted air of a stock brokerage office, where as a boy, just out of grammar school, he took a job as a quotation board boy. He was not a trader, not an investor, not even a student of the market in the conventional sense. He was a boy with a prodigious gift for numbers. He had completed 3 years of arithmetic in a single year at school, a testament to a mind that saw the world in figures. From 10 in the morning until 3 in the afternoon, his world was the big board and the numbers that flickered across it. To him, these were not prices of stocks, not dollars per share representing ownership in great enterprises. They were simply numbers, numbers that were always changing. And in that constant change, he found his first fascination. Why did they change? He didn't know, and he didn't care. His only interest was in the behavior of the numbers themselves. His remarkable memory allowed him to recall in vivid detail how the prices had acted just before they went up or down. He began to see habits, patterns, parallel cases that formed precedents to guide him. He was not yet 15, but he was already learning to read the language of the tape, not as a record of transactions, but as a story of probabilities. He kept a little book, not to record imaginary millions, but to test the accuracy of his observations, to verify if he was right. This private study soon found its first practical application. A fellow office boy, armed with a dandy tip on Burlington, needed a partner to play the stock in a nearby bucket shop. For Livermore, this wasn't about doubling his money, it was a chance to test his theories in the real world. He consulted his little book. His figures confirmed the tip. Burlington was acting as it always did before it went up. He pooled his meager savings, and 2 days later they cashed in. His share of the profit was a mere $3.12. But in that small sum was the seed of a fortune. It was the first tangible proof that his method worked. From that moment on, he became a speculator on his own. He found his arena in the bucket shops of Boston, clandestine establishments where a trader did not actually buy or sell stock, but simply bet on the price fluctuations as they were printed by the ticker. This environment was perfectly suited to his skills. There was no delay, no friction. The price was on the board in front of him. He could buy or sell on the instant, scalping small but sure profits with lightning speed. He was not backing opinions or a favorite stock. He was playing the arithmetic of the tape, a system he had perfected. He was so successful that it wasn't long before the money he made in his lunch hour dwarfed the wages from his brokerage job. He gave up his position. At 15 years old, he had his first $1,000, which he laid in cash in his mother's lap. Before he was 20, he had accumulated his first $10,000. This early success, however, was a double-edged sword. It forged his skills in tape reading, but it also bred a dangerous overconfidence. He was not beating the market, he was beating the shop. The game was simplified, sterilized. He didn't have to account for the impact of his own trading on prices, nor did he have to contend with the delays of executing an order on the floor of a real exchange. He was so good at this simplified game that the bucket shop soon grew tired of his winning. They began to refuse his business, calling him the boy plunger. He was forced to change brokers constantly, even resorting to fictitious names to get his trades accepted. This relentless success was, in reality, a limitation. It taught him one dimension of a multidimensional game, and this lesson would prove to be excruciatingly expensive. At the age of 21, having exhausted the bucket shops of his hometown, he arrived in New York, the epicenter of the financial world. He came with $2,500 and a conviction that he had mastered the game. He sought out a reputable New York Stock Exchange house, a place where the only limit to his trading would be the size of his stake. The atmosphere was familiar, the huge quotation board, the clicking ticker, the crowd of customers. It looked like the same game, so he played it in the same way. He jumped in and out, scalping for small profits, just as he had done in Boston. The result was catastrophic. On his very first day, in just 2 hours of trading, he lost exactly $1,100, nearly half his stake. This was the beginning of the hard part. He was now paying the price for his specialized but incomplete education. He soon realized that there was something profoundly wrong with his play, but he couldn't spot the exact trouble. In a legitimate brokerage, the tape was telling ancient history. The price of a stock on the ticker might be 105, but by the time his order to sell reached the floor of the exchange, the real price might be 103 or lower. The instantaneous execution he relied on was gone. Furthermore, his own orders, if large enough, would further depress the price, an effect he never had to consider in the bucket shops where he was merely betting against the house. He was playing a new game with old, unsuited rules. It took him 6 months to lose everything he had brought to New York, and even to go into debt to his brokers. He was broke. This was the first of several times he would find himself in this position. Each time, the process of rebuilding was an agonizing lesson in humility and a testament to his resilience. He knew there was nothing wrong with him, only with his play. To get a new stake, he had to return to the only environment he knew he could beat. He borrowed $500 from his broker, A.R. Fullerton, and went to St. Louis, home to 2 of the largest bucket shops in the country. His one fear was being recognized. He started cautiously, but his skill was too great. In just 2 days, he made $2,800. But on the 3rd day, the manager called him in. "Listen, kid," the owner said, pointing to the room full of customers. "There's 300 of them, 300 suckers. They feed me and my family. Then you come in, and in 2 days you cop more than I get out of the 300 in 2 weeks. That ain't business, kid. Not for me." He was thrown out. He tried the next shop, only to be recognized and refused business before he could make a single trade. He returned to New York, and the cycle of winning, losing, and learning continued. He would make money for a time, then a change in the market or a flaw in his evolving method would wipe him out again. The struggle for that first substantial, lasting stake of $10,000 was not a single event, but a brutal, multi-year campaign. It was hard because he was fighting against his own ingrained habits, against a market that was far more complex than he had ever imagined, and all with insufficient capital, where every misstep was a potential death blow. He learned that there is nothing like losing all you have in the world for teaching you what not to do. And when you know what not to do in order not to lose money, you begin to learn what to do in order to win. Every loss was a tuition payment. He confessed that his losses taught him he could not begin to advance until he was sure he would not have to retreat. Each time he was wiped out, he added a brand new "don't" to his arsenal of market wisdom. The first $10,000 was hard because it represented the cumulative cost of this brutal education. It was the price of unlearning false assumptions, of discovering the true nature of speculation, and of surviving long enough to put those lessons into practice. The money itself was secondary. The real prize was the experience, the collection of valuable don'ts that he had paid for with his own financial blood. That foundation, built on the bedrock of failure, was what made the next million not only possible, but profoundly easier. With the brutal but necessary education of the bucket shops and his early New York failures behind him, Jesse Livermore had finally paid the steep price of admission to the real game of speculation. The first $10,000 earned through a relentless cycle of small wins and catastrophic losses was more than just money. It was his diploma from the School of Hard Knocks. It was the capital that bought him his most precious asset, the luxury of thought. For the first time in his career, he was no longer a desperate gambler fighting for survival, chained to the minute-by-minute fluctuations of the tape. He could afford to be a student, a strategist, and above all, a patient hunter waiting for the perfect moment to strike. This transition, from a frantic struggle for existence to a calm and deliberate campaign for fortune, was the pivotal point in his entire career. It was the moment he stopped being a player and started becoming the house. The game changes entirely when a speculator is properly capitalized. Without adequate reserves, a trader is forced into a defensive posture. He cannot afford to take even a small loss, for it eats into his very survival. He cannot afford to wait for the true opportunity, for he feels the constant pressure to make money now to cover his expenses. This desperation forces him into overtrading, into making bets on minor movements, and into a state of constant anxiety. Livermore had lived this life for years. His disastrous first attempts with cotton, where he repeatedly jumped in before the market was ready and was shaken out by his own impatience, were a direct result of this pressure. He was trying to force a profit from a market that was not yet ready to give one, but with a proper stake, the chains fall away. A speculator can afford to make what Livermore called exploratory bets. He could test the market with a small initial commitment, and if he was wrong, he could take the small loss without a second thought. This was not a failure, it was the cost of information. It was a probe to determine the market's true disposition. Without adequate margins, it is impossible to take this cold-blooded, dispassionate attitude. The ability to afford a few minor losses is essential for building the confidence to place the big bet when the time is right. Livermore now had this ability. He could wait for weeks or even months, if necessary, for the market to align perfectly with his analysis. This patience, a luxury he had paid for with his earlier losses, was the new cornerstone of his strategy. This newfound freedom allowed him to make the single most important intellectual leap of his life. He stopped being a simple tape reader and became a student of general conditions. He began to realize that the big money was not in the small fluctuations, but in the great movements, the big swing. He had seen it firsthand in Fullerton's office, where an old trader they called Turkey would respond to every tip and every frantic question with the same serene statement. "Well, this is a bull market, you know." At the time, Livermore didn't fully grasp the depth of that wisdom. But as he reflected on his own failures to make significant money even when his analysis was correct, the meaning became clear. Old Man Partridge was not interested in the ripples, he was riding the tide. He understood that in a great bull market, the primary force is upward, and the intelligent play is not to jump in and out, taking small profits, but to buy and hold, to sit tight until the fundamental conditions that created the bull market began to change. Livermore realized that this was his own critical mistake. He would be bullish from the start of a bull market and back his opinion by buying stocks. But then he would listen to the elder statesman in the brokerage office and curb his youthful impetuousness. He would take a 4-point profit and wait for a reaction that never came, only to watch his stock soar another 10, 20, or 30 points without him. "They say you never go poor taking profits," he reflected. "No, you don't. But neither do you grow rich taking a 4-point profit in a bull market." The game was not to scalp, but to correctly diagnose the trend and have the courage to stay with it. This shift in perspective, from focusing on individual stocks to sizing up the entire market and its trend, was the beginning of his journey toward millions. This evolution in thought, from reacting to the tape to anticipating the market's next major campaign, is a journey every great speculator must make. It is the transition from being a tactician to becoming a strategist. While Livermore arrived at this conclusion through his own painful experience and observation, another market genius of his era, Richard Wyckoff, was developing a systematic methodology to do precisely that. Wyckoff taught his students to see the market as the work of a single mind, which he called the composite man. This composite man, representing the smart money and insiders, would carefully plan and execute his campaigns through distinct phases. Accumulation, where he quietly buys stock from the uninformed public. Markup, the sustained upward trend that Livermore learned to ride. Distribution, where the composite man sells his holdings to an eager public at the top. And markdown, the subsequent decline. If Livermore's great insight was understanding that he needed to follow the big swing, Richard Wyckoff's genius was in creating a detailed roadmap to identify how that swing develops. He provided the tools to read the story of supply and demand on the tape, to see the signs of accumulation before the markup phase began, and to recognize the subtle warnings of distribution before the inevitable markdown. Wyckoff's methods provide a logical structure for the principles that Livermore discovered through instinct and trial and error. For any trader who wishes to move beyond simply following prices and truly understand the forces that drive them, the Richard Wyckoff Trading Methods channel is an essential educational resource. It provides a deep dive into this powerful methodology, offering a framework to anticipate and not just react to the market's next great move. You can find the link in the description. Armed with sufficient capital and this new, profound understanding of the market's nature, Livermore was finally able to implement his own set of trading rules that were designed not to catch small profits, but to capture the heart of the major movements. These were the working tools that his hard-won education had prepared him to wield. The first of these was his refined concept of the pivotal point. He had always noticed that stocks showed unusual strength after crossing key levels like 100 or 200. Now he made this observation a cornerstone of his strategy. He would patiently wait for a stock he had analyzed to reach and decisively cross such a point before making his first commitment. This required immense discipline. He described waiting for weeks as Bethlehem Steel climbed from the 80s towards 100. Every point it advanced was money he wasn't making. But he held himself in leash, waiting for the exact psychological moment. When the stock finally crossed 100, he bought and was rewarded with a breathtaking rise of nearly 50 points in 5 days. He had learned to trade not when he wanted to, but when the market told him the time was right. The second rule was his method of pyramiding. Having made his initial commitment at the pivotal point, he would add to his line, but only on a rising scale. Each new purchase had to be at a higher price, confirming his initial judgment and the strength of the trend. This practice, so alien to the amateur who loves to average down, ensured that he was most heavily invested only when he was most certainly right. It kept him from throwing good money after bad and concentrated his capital on his most successful ideas. This rule could only be applied effectively with a sufficient capital base, as it required adding to a position and forgoing the false comfort of buying bargains on a decline. Finally, the most crucial rule of all was to cut losses quickly. With an adequate stake, a small loss was no longer a threat to his survival. It was simply the cost of doing business, an insurance premium against a much larger loss. If he made an exploratory trade and it immediately showed a loss, he didn't hope or wait. He got out. The market was telling him he was wrong, or at least that his timing was off. He would take the loss and wait for a better opportunity. This discipline preserved both his financial and his psychological capital. It kept him in the game, ready to act with a clear mind when the true, low-risk opportunity finally presented itself. These rules, waiting for the pivotal point, pyramiding on strength and ruthlessly cutting losses, were the practical application of his new philosophy. They were the mechanics that enabled him to move from making hundreds of dollars in the bucket shops to commanding hundreds of thousands on Wall Street. The game was no longer a desperate scramble for pennies. It was a calculated, strategic campaign. The first $10,000 had been the brutal price of learning these lessons. It was the capital that bought him a seat at the table. Now, with the rules of the game finally understood, he was ready to play for the entire pot. The intellectual and financial foundation was laid. The era of mastery, and the first million, was about to begin. The final barrier between the struggling speculator and the master operator is not a financial number, but a state of mind. The journey to the first $1 million becomes easier, not because the market becomes more generous or the game less perilous, but because the trader himself is fundamentally transformed. With sufficient capital, a tested method, and the hard-won discipline of emotional control, the speculator sheds the skin of a frantic gambler and dons the calm mantle of a business strategist. The game slows down. He is no longer fighting the market, and more importantly, he is no longer fighting himself. The millions, when they come, are not the result of a lucky guess or a desperate lunge for riches. They are the logical, almost inevitable wages of mastery. This transformation was the true source of Jesse Livermore's power. He was no longer a participant tossed about by the chaotic waves of the market. He had become a student of the tides themselves. He understood that the greatest battles were not against bull cliques or bear pools, but against the twin enemies that reside within every trader, hope and fear. His journey had taught him to reverse these natural impulses. He learned to fear when he had a loss, however small, and to hope when he had a profit, however large. He learned that profits take care of themselves, but losses never do. This psychological fortitude, built upon the ruins of his earlier failures, was his unbreachable fortress. He was no longer swayed by tips or rumors. He had learned, through costly experience, the folly of acting on another man's information. Beware of inside information. All inside information became a creed written on the first page of his notebook and etched into his mind. The industrialist friend who tells you when to buy, he knew, would never tell you when to sell. A speculator must do his own seeing, his own thinking. This independence of thought, combined with his now ample capital, allowed him to play for the one thing that mattered, the big swing. He was no longer concerned with making a living day to day. He was concerned with being right on the great movements. The ultimate test and vindication of this transformation came in 1907. This was not a trade. It was a campaign, the culmination of everything he had ever learned. For months he had been studying the general conditions, and his analysis pointed to one inescapable conclusion. The monetary situation was becoming critical. The rampant speculation and industrial expansion had stretched the credit system to its breaking point. He saw the storm cloud forming long before the first drop of rain fell. He knew a great decline was not just possible, but inevitable. This was not a hunch. It was a diagnosis based on a cold, dispassionate study of economic facts. But his earlier costly mistakes had taught him a final, crucial lesson about timing. Even when one is properly bearish at the very beginning of a bear market, it is folly to begin selling in bulk until the market itself is ready. His first attempts to short the market in 1906 had been premature. The engine of the bull market, though sputtering, still had enough momentum for rallies that were powerful enough to wipe him out. He was right on his thesis, but wrong on his timing, and the market had punished him for his impatience. He was nearly cleaned out. He had seen the pile of dollars ahead, but had started sprinting too soon and had fallen, exhausted, before he could reach it. This time he waited. Broke but not broken, he watched with the patience of a predator, waiting for the unmistakable signal. It came not from the tape, but from the financial pages of the newspapers. The Great Northern and Northern Pacific Railroads announced a new issue of stock, offering it to stockholders on an installment plan. This was unprecedented. For years, the right to subscribe to new issues had been a valuable melon, eagerly paid for in cash. that the most powerful banking houses in the country were now unsure if stockholders could pay cash for a bargain was a signed confession of the profound sickness in the money market. A few days later, the St. Paul Railroad announced its own issue, with a payment date set ahead of the other two, a frantic scramble to get to what little money was left. For Livermore, this was the final, irrefutable confirmation. The time for doubt was over. The time to act was now. He began to sell. Not recklessly, but deliberately, testing the market, adding to his line on weakness, following his own rules. His earlier mistakes had taught him how to pyramid a short position just as he would a long one, selling at successively lower prices. The market was soft as mush. The rallies grew feebler and feebler. He was no longer guessing. He was anticipating the inevitable. His true allies, he felt for the first time, were underlying conditions. They were helping him with all their might. He was short of the market, heavily short, and he was right. The climax arrived on October 24th, 1907. The money market, which had been gasping for weeks, finally suffocated. There was no money to be had at any price. Hell broke loose on the floor of the exchange. Stocks for which there had been bids moments before now found no buyers at any price. It was a vacuum, a black hole of panic. While brokers ran around in terror and the pillars of Wall Street rushed to J.P. Morgan for a bailout, Livermore was calm. This was the moment he had foreseen, the moment he had planned for, the moment all his years of study and failure and learning had prepared him for. That day his winnings exceeded $1 million, but the money was almost an afterthought. The real victory was something far greater. As he later reflected, his biggest winnings were not in dollars, but in the intangibles. I had been right, he said. I had looked ahead and followed a clear-cut plan. I had learned what a man must do in order to make big money. I was permanently out of the gambler class. I had at last learned to trade intelligently in a big way. This was why the million was easier. It was not a lottery ticket. It was the earned profit of a master craftsman. He had conquered the market because he had finally, after years of brutal struggle, conquered himself. This incredible journey from a boy chalking numbers on a board in a bucket shop to the man whose actions could steady a panicked market is more than a story about making money. It is a saga of human struggle, intellectual growth, and the relentless pursuit of mastery. It is a journey into the mind of a speculator. And there is no greater guide to that journey than the book that has become a timeless classic for traders worldwide. Edwin Lefebvre's masterpiece, Reminiscences of a Stock Operator, is not simply a biography. It is a psychological thriller, a deep dive into the internal battles with hope, greed, and fear that define a trader's life. It captures the very essence of the game. Yet to fully unlock its secrets and translate its century-old wisdom into a winning edge in today's markets requires a key. That key is the detailed chapter-by-chapter analysis by Max Davidson. It is an indispensable companion, a guide that deciphers Livermore's timeless principles, breaks down his strategies, and illuminates his psychological insights, making them profoundly relevant and powerfully actionable for the modern speculator. If you are ready to move beyond simply reading the story and begin truly living its lessons, the link in the description is your next step.